Mid-September 2007, they cut rates by half a basis point. The market peaked 3 to 4 weeks later and collapsed during a whole cycle of rate cuts. So if you're cheering the possibility of rate cuts, do your history. When the Fed cuts rates, they're panicked. They may not admit it, but they're panicked.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 10th through June 17th, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo Bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. I did want to discuss the big news right now is the Fed meeting. So we saw the Fed meeting this Wednesday. We're recording this on Friday. Your perspective on the Fed's decision to keep rates constant, and do you think the markets are anticipating a cut pretty soon?
Probably. They've been anticipating that for so long. I have great disrespect for the Fed in general, the whole concept, and they usually are always behind the ball. Events happen and they say, oh, gosh. There's some analysts now who recognize and are even saying that they're going to be too late this time. In other words, the events will occur and then they'll have to panic. We already see economic data points that the Fed doesn't particularly want to mention, and I'm wondering why. But, the unemployment numbers are not good. The employment numbers are not good. It's only the superficial top line number is, and it's as if it's been doctored almost. It's all part-time jobs, And there's a lot of other economic metrics that are reflecting something wrong. Okay. Also, everybody's looking at tech. NVIDIA, a few others. Apple right now popped to a new high finally, over 200, which we expected to see. But when you look at things like, maybe we don't need banks anymore, but look at, KBE, the bank ETF, and look where it is. And look at RWR, which is it's a REIT, Real Estate Investment Trust ETF. And look where they are in relation to the price action of the last 2-3 years on their price charts, just simple as that. And then look at an S&P and say, these guys are in different universes. These asset categories. And maybe we don't need commercial real estate. Maybe we don't need banks, But if you do, then pay attention to what they're doing, because this happened back in 2007 as well, when the stock market was topping out, which in late 2006, we thought it would top in 2007. We warned people, beware, it would top next year. And we had a zone where we thought they'd get to. And I'll be darned if they didn't get there. It was in September, October of 2007. But if you looked at the S&P then popping to a new marginal high, and the Fed had actually cut rates then, after a couple of years of rate rises, they cut rates a half a point. Remember, there's the underlying real estate crisis. But if you looked at banks and real estate type stocks at that point in time, they were in puke mode, okay? They were looking horrible, and yet the stock market was just full of glee. And then we had the disaster that followed. We think we're going to have another one. I don't like to applaud other fundamental analysts, but there's one in particular I do like a lot. That's Jeff Gundlach. He was on CNBC the other day commenting on that Powell talk. And he had basically our same view, and is one, they're too late, and no, we're not going to have a soft landing. He said it in very polite terms, but that's what we think. So anyway, that's what I see. I think that the Fed has already lost the game, and they're going to find out very soon. I suspect in the third quarter, the stock market's going to exhibit failure.
No, it seems like maybe in the mainstream media, there's this thought of, well, we've already seen a soft landing in a sense, right? Because inflation is down and the stock market is roaring higher. The economy's, not doing terribly. But it seems like the worst is still yet to come?
First off, the inflation, they measure it via their own government ways, and it's not necessarily the way that the average family sees inflation. Okay. But you got to realize that commodity prices, the Bloomberg Commodity Index, for example, exploded from a low in late 2020, well before that war ever started over there, and reached a high and peaked in March of 2022. 1 month after the Ukraine-Russia war started. So you can't blame it on that war. Commodities had already exploded, oil, grains, the whole deal. Since then, they pulled back. Commodities had a corrective pullback, about halfway back what they'd gained. And they laid low, commodities did, over the last year and a half actually, where after you drop from the 22 high, they went sideways. Oil dropped from 130 down to the 60 to 90 range, and so forth and so on. And so their metrics that they measure are lagged to what Bloomberg Commodity Index is doing. And their metrics are now showing a slowdown. Well, that's already been reflected in the commodity complex a year ago. Now the commodity complex, by our momentum metrics, is turning back up freshly. And no, it's not dynamic at this point, but there's too many markets within the Bloomberg. Energy's included in this, the grains and so forth are starting to turn up in ways that we can measure that tell us, this is a real upturn. So what they're cheering now, their little modest downticks. You're about to get another wave to the upside in commodities. And this time, commodities will be in sync with gold. They weren't back in 2020 to 2022. Gold had already doubled at the point where commodities were just bottoming in late 2020. Gold had already gone to $2,000 from its low at $1,050 back in 2015. So, but now we're back in sync, where gold, we know, is surged. Monetary metals have, and the commodities are starting to turn up as well. And another event's occurring, I think, that is really a table pounder. And it's the T-bond market. The T-bond market, the very long end of the U.S. government debt market, 30-year plus, that got 20 to 30 year, has been under pressure, meaning rates rising as the prices go down. And it's been contrary to the stock market. As the stock market's risen since late 2022 in particular, T-bonds have gone down, yields have continued to go up. However, the technicals of the T-bond market tell us that there is going to be an upside explosion in the T-bond price action, likely to last for a couple of quarters, so maybe several quarters, meaning a sharp drop in yields. And this is at the long end. We're not talking about the stuff that the Fed controls, the short-term stuff. And I think there's a reason for this. I think the reason is not good for the stock market. And I think likely this breakout that we're now seeing, as we talk now, this week, in fact, the T-bonds and TLTs, a popular ETF that's a good metric as well, are breaking out on long-term momentum, telling us that we're going to have a very strong move to the upside or drop in yields. What for? Why? It's not because the Fed's cutting. And plus, we're talking the long end. I think it's because there's asset class movement out of the high-risk stock market into the bonds for safety. Once again, that didn't work in 2022. Bonds went down with stocks. But since then, stocks have risen and bonds have continued down. I think they've now flipped. And that asset category breaking out to the upside, T-bonds, I think is now in sync with gold. Again, as an alternative place to be.
And mentioning gold here, we can pull up the charts you just sent me. The monthly closes we've seen in gold and silver. Your take on the recent pullback we've been seeing and really the long-term trends these charts show?
Well, when you look at those charts, the action of gold month-to-month closes. Now, we urge people that if you're an investment, have an investment position in the monetary metals, not a trading position. You're looking out. We got bullish in February 2016 and haven't altered our view. At that point, gold was 1140. But we've now recently reemerged in gold. We all know that. You can even see it on a price chart. But we saw the breakout on long-term momentum of gold and silver back in March and April. That point in time, silver was coming up above 25, which didn't look particularly important on price charts. And in the case of gold, it was coming up at that 2000 level again, where it had been a couple times before in the last several years. And we knew that it was about to launch again. Well, when you look at the gold monthly closes, there hasn't been a down close yet, including this month. The last April, we had a high close, May a little higher, and June still a little higher. There has yet to be a down close. So everybody who thinks there's this big correction going on, yeah, intra-month there have been some gyrations. But when you stand back and look at the bigger picture, it's just steady as a rock. In the case of silver, you had your peak monthly close last month. And right now, this month, we're down 2.5% on the month. Wow, big deal, okay? Again, we got super bullish again, just above 25 back in March, April. And so we're getting a pullback. And right now we're trading just below 30. And I'm going to argue this case that those who've been doubting gold and silver for the last 3 or 4 weeks, thinking, oh, we're going to have a multi-month correction and we're going to drop back to 26 silver and gold's going back to 2,000. If gold gets back over that 2,400 mark again, now 3 months in a row, it's traded over 2,400, April, May, and June. That's not a top. When gold tops, it makes a high and doesn't come back to it. We've gotten over 2,400 3 months in a row, which shows that it's comfortable. You get back over there again, I think you're going to launch gold in a more dramatic way even, where you might be over 3,000 very rapidly. And silver like as well, leading the game. In fact, if you look at silver, gold's trading below its April high, intra-month. April, May, and June have all reached 2,400. So it's just consolidating sideways when you look at a bar chart, including the highs and lows. In the case of silver, we're out above the April high. So silver's actually been stronger than gold, despite the recent intra-month pullback in silver. So I think the monetary metals are the place to still be. I think the big move is still underway, has really yet to expose itself. And this time around, I think a lot of asset managers are looking at it favorably over the past few months, especially, and also T-bonds.
It is pretty dramatic what we've seen in the last few months for precious metals, and as you mentioned, really that 2,400 level being very critical for gold. And now for silver, obviously that $30 level, that's a lot of what people are talking about.
No, 30 was a spike. If you look at silver's highs since 2020, just on a bar chart, not that chart I sent out, which is a monthly close only, but if you look at a bar chart, you'll see there was a brief spike above 30 that occurred in 2021, very brief. I don't think there are any monthly closes up there. And then you retreated sharply, whereas gold had flat ceiling, got over 2,000, 2020, got over 2,000 again in 2022, got over 2,000 again in 2023. So it had a flat ceiling. Silver, on the other hand, had descending highs. While gold was going sideways, silver made lower and lower highs. So that 30 was the topmost peak of the pattern of descending highs. In fact, its last set of highs that it broke through was at $26. So we haven't even pulled back to there, and I don't think you're going to. Okay. So pulling back below 30 is not technically important. That's one single isolated old high over there that lasted, I think, a week. Okay, but most of the highs in silver since 2020 have been in the mid to upper 20s, not at 30. So it's not technically important. I know a lot of people think it is, but it's not. And I strongly suspect that the pullback we had in silver this week was it. That was the low, I believe. That was 28.73. Right now we're trading 29.60 something as we do the interview.
Now, I know last time we had you on, you were saying, don't even think about selling at this point because of the price structures we're looking at right now, and that silver could, within months, get back to all-time highs. Do you still believe that?
Yes, I think when gold gets above that 2,400 ceiling, that it's defined 3 months in a row, meaning it's a happy level. It's not thin air up here for gold. Thin air is like the 2011 peak. Go back and look at it. When you hit 1,920, you collapsed. You could never even get back to 1,800 after that. Okay. Then look at the 2020 high in the year 2020 when we traded up to 2,070. When you dropped from that high, it took you 2 years to get back to that 2000 level again. When you dropped, you dropped, okay? This time we hit 2400, pull back, 2400, 24. Something's going on here that says, no, it's not thin air up here. The market's quite comfy. So people who think it's overbought, I think, are totally wrong. This is just a mild congestion zone. And when you get above that 2400, especially 2500, I think you'll see some drama that most people would be surprised by.
And we talked about how during, with the Fed and what they're doing and what we're looking at is possibly a hard landing. That definitely gives some fundamentals of why we'd see precious metal move higher from here. We're also seeing a lot of geopolitical tensions. Do you have any perspective on that, how that is going to be impacting things in the coming months and years?
I think that I'm not concerned about the geopolitical tensions such as the threat of war. I don't think that's an issue. In fact, in my history of knowing gold since the mid-'70s when it was legalized, it's never really responded to a war event. There might have been a war event here or there, but it really wasn't part of a driving force behind gold. What drives gold, it's money. And when you depreciate the money units by which you value price gold, whether it's in euros or yen or dollars, and that unit of money is depreciating in value continually, gold goes up continually. It's as simple as that. And when you have a crisis that's pending, especially certain asset categories that central banks don't want to see go down, stock markets, that's when they'll depreciate the money even more in their effort to put out the fire. They'll flood it with the new river of liquidity, lower rates and so forth, but mainly the river of liquidity. And you can bet they're going to do that. And the one spark that always gets them going is when their stock markets break. And I think that's what's pending. Now, I mentioned the structure on T-bonds on momentum. You don't see it so evident on price, but on momentum, we have this massive ceiling, which we've hit and hit and hit for 2 to 3 years now. And when you go through that, and you're going through it right now on momentum, you're going to launch. I made a point in a report we sent out this past week to our subscribers that this is very similar but upside down version of what the 1987 stock market crash looked like. Back then, you had a situation where the S&P 500 had a floor under it, that it kept hitting and hitting and hitting on momentum, not on price. Price was looking happy. Momentum had created this floor. And if you broke that floor, and you broke that in the second week of October, and by the third week, you crashed. And that price chart looked lovely just before the crash. There was nothing on price that told you, the floor just opened up. The inverse is happening with T-bonds right now to the upside. Now, when we look at the stock market, not its price, which looks, it's chest beating. We know why, because 5 or 6 stocks. When we run momentum of the S&P and the NASDAQ 100, quarterly momentum, for example, and that's where we measure monthly price in relation to a 3-quarter average, the oscillators have structure underneath them, such that if you drop, and I'll throw out a rough number right now, Q3 is about, starting Monday, is 9 trading days away. There's only 9 more days left in the month starting Monday because there's a holiday. You get into that next quarter, and you see the NASDAQ pull back about 5%, it's over. You're going to see some horrendous drop, and that's the leader index. And I think what you're seeing in the bonds now, this upside breakout in momentum, will be opposite in the stock market. And I suspect it's going to happen very soon, meaning especially when we get into next quarter. That's when the Fed will panic. And
I know the Fed says that they're apolitical, but we do have a election coming up as well, which seems like there's even more incentive then to reverse policy and to save the stock market and economy.
Well, I've heard that probably it's correct that all the Fed members are against Trump. Okay. Now, I'm not going to take sides here. Okay. But I'm just saying they're all against him. Some of them have even contributed to the other side. But is that the reason, for example, and people are wondering, why does he keep talking about the positive economy? One, the job market looks good and the economy looks good and inflation's cooling off. These are all points that, obviously the other side of the political equation would like to hear. Everything's rosy, right? And so the Fed is echoing that. And yet there's a rising wave of people who realize, even people who are pro-Fed in the past, realize it's not true. Why is he doing this? And so there's a doubt, a wave of doubt hitting. And when that stock market breaks, that wave of doubt will say, gee, what'd they do this for? Why did they say that? Why didn't they cut earlier? Because they're going to be in an awkward position. Because if you delay the rate cut to, for example, September, that looks very political. That looks like, they're trying to save the game. So they're in a real pickle. And, chuckle. It's they created the problem. They'll have to deal with it. And I think gold knows that. It knows what's coming. I think it knows the stock market is a massive bubble, biggest in U.S. history. And when it breaks, there will be pain. And the central bank will further depreciate the underlying value of the money in the effort to hose down the fire. That's why gold's up here in the first place. And I think that's why T-bonds are starting to turn.
I remember back during the banking crisis last year when we saw many banks fail, the Fed, I believe, raised rates after that and then paused. So it seems like, one could read into that they were, not wanting to react to just what was happening immediately. But you're thinking that they might have to this time, is they might have to immediately reverse.
Well, I don't. What Powell says is one thing, but the FDIC said in a report this week, there are 63 banks that are problem, quote, banks. 63. And there's like $500 billion, if I'm not mistaken, in unsecured debt that is in jeopardy in the banks. Now, Powell didn't mention this. His only comment was the banks look good. Okay. So what happened last year that you're talking about, which was a mini crash, actually. And by the way, they never really recovered from that. If you look at the bank sector or look at RWR, the real REIT sector, very important sectors. They've bounced off their low, but they're nowhere near back at the 2022 highs. They're laying in the real estate sector is laying in the bottom quarter of the last 3 years range, comatose. And we can't have commercial real estate go into another down leg, because that will do what? It will damage a lot of banks. And Powell glibly said, no, the banks are in great shape. This reminds me of what Bernanke said in 2007 about the mortgage market. No, it's manageable. Okay. Anyway.
And how do you think the banks will be impacted by this downturn in the stock market?
Well, they may lead it, and then finally people say, hey, what's going on here? We can't ignore this anymore. And when the Fed starts cutting, I've said this before many times, that you go back and look at the 2000 top, the dot-com bubble. The market peaked in August 2000, and by the first day of January 2001, moderately off the high, but headed down, the Fed cut rates. They started aggressive rate cuts. Market collapsed all the way down. As soon as they started cutting rates, boom, boom, boom. 2007, they printed the top. Mid-September 2007, they cut rates by half a basis point. The market peaked 3 to 4 weeks later and collapsed during a whole cycle of rate cuts. So if you're cheering the possibility of rate cuts, do your history. When the Fed cuts rates, they're panicked. They may not admit it, but they're panicked.
It will be interesting to continue to track this with you, Michael. Thank you so much for your time today. If our viewers are interested in signing up for your momentum structural analysis, where can they find you?
At OliverMSA.com. And you can read what our methodology is and see some of our past reports and request some samples.
Any last thoughts before we let you go?
No, it's going to be a lot of this is going to unfold between now and the election, not after the election. A lot of these dynamic trends are going to unfold before then. So it's a different kind of market. I'm talking stocks, bonds, and gold. The dynamics will be terrific. And I think they're going to be terrific in the next 6 months, especially.
All right. Well, Michael, thank you so much for joining us today, and God bless.
Thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 10th through June 17th, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo Bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.